Hey everybody, this is Phil Town.
And this is Danielle Town.
Welcome to the InvestED podcast number 493, y'all.
I think it's so funny how all of a sudden you're so into the numbering.
I've been watching All In podcast and they do that. They're very professional. By the way, if you haven't seen this,
Dad, you've said this like every episode.
Well, I'm saying it again.
Everybody knows.
Go watch those guys. They're really fun to listen to. All right, so what are we doing today, Miss Town?
We are finally going to talk about if you own a company and then that company has an event while you own it, what on earth does one do? Like, is that a big deal? Is it not a big deal? Is it something that you should think about, oh, I could buy more? Is it something where you should think about selling? And I'm guessing the answer is like all of the above. But do you handle that differently than a company, say, on your wish list that you would like to buy?
Well, yeah, because it's a lot more critical if you own it already, that you understand what the event is, particularly whether it's going to be something that creates so much uncertainty around the business that you don't want to own it anymore.
Yeah. Okay.
Or even worse, there's certainty. The event is going to kill this business. And so when you own the business, it's a lot more intense when there's an event. And by the way, with event, what we mean is something that happens to the business or the economy in some way that is a negative thing. In other words, it is a negative thing in the sense that it really brings up the question of whether this business is okay. Something happened, right? And we've talked about this over time. So
it's a good point, though, that you say how you define event, because part of that definition is that it is something that resolves itself within roughly 1 to 3 years, right?
Ideally, it is. In which case, if we know it's going to resolve itself in 1 to 3 years and things will get back to normal, then this becomes an event that we can invest on.
Yeah, like that's because that's what we're looking for wish list companies.
Exactly.
An event where you can go, okay, like the price is down. I'm confident it's going to go back up. I see the true value and I just have to ride it out. And that's super interesting because that means that if it's not one of those situations in a company you own, then it's not an event. It's something else, bad news.
Well, yeah, I mean, if it's not causing the stock to go down by a big block, right, by a lot, 20, 30, 40, 50% drop in the stock price, then the market is absorbing this as something that happened which doesn't create uncertainty. It's the creation of uncertainty that's triggering the exit out of the stock.
Or
right?
It's something that doesn't seem like it'll get resolved.
Well, yes, but the resolution time period for the investors who are exiting that stock, which we're talking essentially about institutional fund managers who are exiting the stock, running from the theater because they think they smell smoke. Mm-hmm. Their time frame for that resolution is very short. It's under a year. And so their time frame is so much shorter than ours because they're not long-term investors. They are competing on a very short time frame, a quarter, 2 quarters, like that. So if they're uncertain about what's going to happen to this company over the next year, that's too long. And if it's going beyond that, that's way too long.
For them.
They're going to exit. Yeah, they're going to exit. Now, what that does is obviously it causes the price to go down because the exit will generate more exiting. If one person gets out, goes on CNBC, says there's a problem, I don't really like it, I'm out of here, that affects all of the lemmings on Wall Street to follow along because they don't want to get caught in a situation that they don't understand. And they can't possibly understand all the businesses that they own. Mm-hmm. So they just get out with the rest of the market. And that, of course, is a self-fulfilling cycle.
Right.
somebody gets out, and then somebody gets out, and then it goes down, and I knew I should have gotten out. I'm so glad I did. Well, for us, if we own the business, it's a pretty different situation than if we are looking to buy it. If we're looking to buy it, we're sitting there going, aha, this is coming into our price range where we can really think about buying this. And we also understand why. It's because we see the event from the lens of being willing to wait up to 3 years for this to resolve itself and having a high degree of certainty that it will resolve itself within that period of time from seeing other events typically in this industry, right? This won't be unlikely that this is the first time this kind of thing has ever happened. So with Chipotle Mexican Grill, it's not the first time in the restaurant industry that anybody got E. coli. With BP, it's not the first time somebody had a well spill oil. Just on and on like that. There's almost always an example out there of what happened and how long it took. And when cotton prices went through the roof because of an Egyptian internal political event, cotton prices triple. That's not the first time that's happened to cotton prices. So you can look and see, well, how long is it going to take to normalize? And the answer is, well, it's going to take 3 years. Well, it's way too long for a fund manager in New York. They're just not going to hang in that long. And so they're gone. And we are looking at this and going, oh, great. Okay, we can buy this because we understand the business. It's on our wish list. And this is the event we'd hoped for. Now, if we own the business, it's another story.
Exactly.
The first thing is our portfolio, and because we're judged on we're judged on a day-to-day basis. I mean, our investors can see where we're at mark to market every afternoon, and so
who's we?
Who's we?
Who's we? You said our investors can.
Oh yeah, in our who's we? It's our fund. I have a
your
fund.
Yeah, but I'm not in it.
No. Oh, you thought I was encompassing. Yeah, but really, the question is, why are you not in it? But we'll go into that another day.
Tell me about it.
So, yeah. I mean, we are, after all, in our peer group, the number one return over the last 5 years. We just got that information from Morningstar. That was great. Okay, beyond that. What? You're rolling your eyeballs.
I wasn't. I'm just not sure you can say that kind of thing.
Yeah, I can.
Okay. You can? Okay, legal. Good.
So we don't talk about it much, but yeah, we're out there. So the thing is, when we own this business, then we know that we're going to be taking this hit on a day-to-day basis because that stock is going down, right? And let's say we've owned it for a while. That typically means we have a pretty good cushion. Let's say we've owned it for 3 years and we made a good analysis. That means that if we bought this stock at 20, it's probably by that time back up to 40.
Oh, sure.
Right?
Okay, yeah, fair enough. Yeah.
And that's important because now we have this huge profit cushion.
Yeah, totally.
To ride out this bump while it's making our short-term returns go down, it's not making our long-term returns go down.
Mm-hmm.
So, and that's really important for us to be able to see that long term we've made good decisions, that things are working out. So when this starts going down, if we've got a profit cushion, then we're not quite as intense about it because we've got a lot of room. But we are, of course, very interested in what this event is. Did this thing change our story about this company such that we have to look at whether we want to be owning this anymore?
Exactly, because I think this actually kind of accidentally gets to the crux of the problem we've been trying to attack of what do you do when you own a company, you think that it's at the top of its intrinsic value, you're ready to sell it, move on to something else, and then we figure out that we sold too early. And this is one of those things where it's like, something's happened. No? Mm-hmm. Yes or no?
Yeah.
Yes. Oh, yeah.
Something's happened.
Okay. It's looking maybe like the company. So by definition, it's not an event unless we think the company can come out. It's not a capital E Rule 1 event. unless
Right.
the company can come out of it in a couple years. And if it can't, then yeah, why would we want to own it anymore? That's
Well, I'll give you an example. We just went through this with a company. We've talked about this on the podcast before. We really loved this regional bank called Bank OZK, and we've owned it for years and years and years through thick and thin, and we have doubled our money in the investment. So okay,
nice.
this is exactly this situation.
Mm-hmm.
There's an event. I'm going to broaden this definition of event. An event is something that happens, typically front page news in some business thing. And we don't know whether it's something that's going to cause us to invest or cause us to get the hell out. So it's an event.
I mean, that would be the definition you would expect. Yeah.
Yeah. So now these guys have an event that's front page, that they have made their biggest loan to a life sciences company in San Diego.
Oh, yeah, we talked about this.
Right?
Mm-hmm.
And they have no tenants in the building. The developer has no tenants in the building. They didn't lease it up. And it's empty. And they've got and Bank OZK has almost $1 billion loan against this thing. And we went, wait a second. What do you mean? As they explain this in a report that's done by a short seller who dug this out. It wasn't presented by management. A short seller dug this out. It made it into the newspaper. Yep. Like the short seller went out there and found out this place is empty.
I love short sellers. I'm sorry. I know they get such a bad rap, but I just appreciate the level of investigative reporting that some of these guys do.
Oh, it's serious.
And it roots out these bad actors. It's fascinating.
It does. And of course, the rules around what you can say about a company publicly are pretty different if you're a short seller, because you don't own any of it, and you have basically borrowed stock and have the broker sell it, and what you're hoping to do is buy it back much cheaper. So it's allowed for you to go out and say all kinds of bad things about the company. So companies that are getting slammed by short sellers often feel that they're being treated unfairly, that you can't have a similar balance by just saying wonderful things about the business and how great it's going to be. You don't get to do it equally aggressively. And so they'll often claim the short seller is just making this stuff up, and they sometimes sue the short sellers. So in any case, just to finish my story.
Yeah, go ahead.
That the short sellers say that, okay, this is a problem, and we are shocked, not because the short seller found it, is because the short seller found that they haven't leased this place up. And what we understood the strategy to be for OZK lending to real estate was that the developer would use their own money to get to a certain point in developing, and that point would be where they could lease up the building. And upon the leasing of the building, then Bank OZK would come in with the funds to complete the development. These guys didn't do that. Whoever made the loan at Bank OZK didn't require that they lease up the building, which was completely not what they were telling us from our point of view. Okay, obviously, we went back to management and said, what has happened here? And management told us we were mistaken, number one, in our point of view, that they in fact do lease buildings, and at the same time told us that they don't. They gave us two completely opposite views of this thing, and it led us to the conclusion, since they actually did lend the money and their biggest loan ever, without this building being leased up, that our understanding of this bank's story was either changed or mistaken. Mm-hmm. And on that basis, we looked at it and said, do we want to be involved in a bank that's making speculative loans? Mm-hmm. And the answer is no. And so we got out. Just that simple. And so in this case, the event I'm sure there's a very good chance that this is going to resolve itself. It's still underway. And the bank's stock has somewhat recovered from the shock of the short seller's position. But we're not interested in being back in it. It's just
So in that
there's-
situation, it changed the entire story. It wasn't. It's not something that's limited to this bad news
to
that
just
happened.
that bad news.
Yeah. And in that situation, it doesn't actually matter if you think that company's still going to do better in the future. You don't want to be involved in it. You're out.
Exactly. For us, that just became a speculative investment,
Yeah.
and we don't make speculative investments.
And so that one is not a situation of, I still like this company, but I'm going to get out because maybe I could use my money better elsewhere.
Right.
It's I'm done with you. Thank you very much.
Right. Now, one where we made the decision to, use the money better elsewhere was an early investment in Chipotle years ago, before we even started the podcast, I think.
Yeah, it was before we started.
Because I'd written about it in rule number 1 back in 2005 about how great it was and what we did in it. And so this is one where the stock has gone way higher than it really should have, according to what we think its real intrinsic value is. And we were basically wondering, okay, at what point do we say this is really too high? We need to move the money out other places because it just won't keep growing like this.
Essentially, like, take your money off the table because you're doing good.
Yeah, because you're doing good. Now, that decision, I regret. I've learned from that one that if the company is a franchise kind of, by a franchise, I mean something that has just got this capability of growing and growing and growing at a very high level of compounding our money, which we knew Chipotle was like that. They were growing historically at 21% a year, and we saw nothing in the way of them continuing to grow at some area around that, some very high growth rate. Mm-hmm. That it is, I will tell you now, that's a mistake to take your money out of a business like that. They're so rare, even if their stock drops 50%, which this has done a couple of times, you just can't take it out because it's very hard to buy back in. It's very hard to just go, okay, part. Now I'm going to, now
you go like, oh, okay, I'll sell. I mean, that was the mistake I made. It was a huge mistake. There was an event around pork price, the commodity pork, and the price dropped, and I was like, oh, okay, well, I can always just buy back in, but if this turns out to be a big deal, then I'm out.
Yeah.
But then I couldn't buy back in because it shot straight up, and I missed my chance.
Yes.
And then I was just out.
Yes,
huge mistake.
Absolutely.
I mean, it's one that I'm actually glad that I made because it wasn't that much money, and now I know.
If you've got that big internal growth rate, and by the way, you guys, this is what makes investing in companies so much different than investing in anything else, including real estate, is that this is the only kind of investment that I'm aware of that has the ability internally to generate high compounded rates of growth of your money, of your equity in that business. So you put your money in a company like a Chipotle back when it was growing at 20% a year, it's growing your money at that rate, which is just phenomenal. I mean, you don't have to do anything, just sit there. And the stock market doesn't have to go up. It's just that business is creating value at the rate of 20% additionally every single year. And someday the market will appreciate that and put the price where it should be. But that's why Buffett says, I want to own businesses where if the market shuts down tomorrow, I don't care, because these are not businesses I ever want to sell.
Yeah.
And the market will come back, and we'll be able to. And even if the market never comes back, you've got a private company that is phenomenal at producing these great rates of return.
Great point. He also said, I'd rather own 3 businesses than the market, because 3 businesses that I understand is safer than being diversified in the entire market. Yes,
massively so. If you'll think about it, we call those businesses, and again, I think we've talked about this sometime in the last 8 years, we think of those businesses as being antifragile. From Nicholas
we
Taleb.
haven't talked about that for a long time. We talked about that more when we were like writing the book. But yeah, it's a little bit of
it's such a key thought about when you're thinking about owning these 3 businesses, as opposed to diversifying across the whole market and thinking, well, the market is certainly long term, the right place to be, and it's in that sense anti-fragile because it's going to come back. But in fact, you're giving up enormous growth and enormous rates of return. If you've diversified across the entire market, the majority of the companies you own are not anti-fragile. The anti-fragile companies are the ones that are going to massively benefit by overtaking other public companies in their markets during a major downturn. Those companies are going to benefit from the tide going out by overtaking weaker public companies. And so you get this enormous burst of growth after there's a problem in the economy or in that industry that you don't get from the market as a whole. That's why the market rate of return in a bull market that's just gangbusters, the market's on fire, is like 13% a year compounded, would be enormous.
Yeah.
Whereas you get a bunch of companies that are anti-fragile and pick them off at a low price, you could see 30% compounded growth rates. And the difference is just enormous. A 13% growth rate will double your money every 5.5 years, something like that. A 30% compounded growth rate is going to double your money every 2.5 years. So if we took $10,000,
say that again. That's wild.
Yeah, if we took $10,000 and we're in the market in general, and it's a bull market and it's growing like crazy over a decade, that would have gone from 10,000 to about 18,000 over that period of time. It would have. Let's see. Am I doing that right? No, it's doubling every, let's say, 6 years. So it goes from 10 to 20, and then from 20, it's not another full double. It's like 2/3 of a double. So 20 becomes 30, 35, 36. So you've gone from 10,000 to say 36,000 at 13% a year. Now you do it at 30% a year, you have 4 doubles in that 10-year period at 2.5 years per double, right? And so you go from 10 to 20, 40, 80, 160. So here you are at 36,000 by diversifying into a group of companies, most of which are not anti-fragile, versus going over to a handful of anti-fragile companies, buying them inexpensively, and you're ending up with, 5x, 4x difference? See, 10, 20, 40,
difference.
80, 160. Yeah, you're looking at more than 4 times higher. And safer, because these companies are safer than owning a bunch of not anti-fragile companies. So anyway, that's I think how you best play the game, and why anti-fragile is so important, and why you would hold on to companies that are anti-fragile, like a Chipotle, over a long period of time, even though the stock is going to go down in a downturn.
So that's the thing. I think using those, using that criteria of an event, which is helpful because it's the same. It doesn't require a different checklist. Doesn't require a new understanding. It's just like, okay, I already did this analysis on this company. I'm going to do it again and find out if I think that they're going to come out of this one, or if it's really fundamentally changed the story. And then if they are, then you stick, right? Yeah, you stick.
Okay. And that's emotionally difficult for a lot of people. And I think that's one of the real tests, I would say, to test whether you're right for this way of investing, is can you be unemotional about a Chipotle going down 50%, right? Something that's anti-fragile, you love the business, you know it will grow longer, it's going to be bigger in 10 years, no question. And yet the market, for whatever reason, is going down 50% in the stock. Can you take that with a high degree of equanimity, or are you going to freak out? And I think that's a real. What do you think for you? I know that, I'm pretty comfortable with that stuff, but I've got a lot of experience with it too, and that helps.
I know for sure. I'm pretty good at it. It takes me a lot to buy something. That's where the scary bit is for me. But once I'm in, I'm in. And I've done that thought process. Like I'm gonna stick with it. And I think especially having done that idiot sell with Chipotle, which was the opposite of what I'm saying.
Mm-hmm.
I've now had that experience. I know what that feels like. I've practiced it, essentially, at expense, great expense. And I learned from that one. So I think there will be many more situations where I make the wrong choice, but as long as I don't do it a second time, I'm okay with that.
Well, there's lots of lessons in there that we have to learn to be unemotional about this stuff. And the main one is that the lesson that you're right. You know, you made a good decision.
Yeah.
Maybe you made a bad short-term decision in terms of the investing side of it, but you made a good long-term decision in terms of the company.
Yeah.
And so that helps. Like we bought Sprouts when it was getting hammered, Sprouts Farmers Market, SFM. At $22 a share, I think is our average purchase price. And it wouldn't go up. I mean, it just sat there. And then it went down a little bit, went down a little more. And, you know, at some point you own all of this that you want to own. And particularly when you have rules from the SEC, there's a limit to what you can put into any one company. And so, you know, we're sort of sitting there going, why does the market not see the massive cash flow being thrown off by this business? We just don't get it. It's just the market's completely blind to this. Mr. Market is so caught up in something. We just don't know. This is one of those things where you look at it and you just go, I am baffled.
Looking back, do you have any different perspective on it?
No, we remain baffled.
Okay.
Well, particularly because the market finally figured it out. And here's what happened. That stock, when the market decided, oh yeah, these guys are printing money and they have a big moat and they do things differently. And that's why all of a sudden it recognized it. And it's the weirdest thing when you watch this suddenly take off. Because you know how they can go down in an event. Yeah. Well, when the market recognizes it's made a mistake, it can go up like a rocket. And that's where you can't get back in.
Right.
It's like explodes. Right. And then you wake up 3 weeks later and the thing went from 22 to 40.
That's what I was going to add about the Chipotle experience is that I realized it wasn't just the mistake of getting a little worried. It was me trying to be clever. It was me trying to be like, oh, I'm going to, you know, sell here and then buy again and I'll make a little bit of money and, you know, go me. And like... Yeah. That's just dumb. That's not my genre, you know? Like, that's not my jam. I'm not good at that. And I should have remembered that I shouldn't try to branch out into that stuff and spend my time doing something more useful, quite frankly. That's the other lesson from that one.
But that is the truth. I mean, once you've invested in some great anti-fragile companies, you got a lot of time on your hands. You really would do well to forget about them and just... If you have to choose between being overly involved and making moment-to-moment decisions, it'd be much better really just to forget you own them and come back in 10 years. Exactly.
Yeah. I think at some point recently we were talking about how you kind of have to get out of your own way sometimes and not try to be fancy and clever. And that was definitely me trying to be fancy and clever and sort of getting excited by a new toy. And that would just... I'm glad it didn't work out because otherwise I'd be talking about how good I am at like selling things and then rebuying them.
Right, exactly. You learn the wrong lesson and then you spread the disease.
Exactly.
And, I mean, look at what happened with Sprouts. You know, it jumped to 40 really fast, and then the market started to realize the market's a pile of lemmings. I mean, institutional investors are just going to follow other institutional investors. And that's what happened. And it went all the way up to almost 160. I think it's around 135 now. But look at that, from $22 to $135 in a matter of like a year.
It's one of those just dream
after
unicorns.
Waiting a couple of years, sitting on your hands, trusting that you understood this business and the market doesn't, and you don't know why they don't, and it remains it baffles us. And now we sort of think they may understand it too well. It's like they love it so much they're bidding it up to a place where at some point we have to think, wow, is this Is this where we no longer, is this where we can use our capital better? And
But do you have to think that?
That's where you got to look at their growth rate. You've got to look at what they can do internally. How anti-fragile are they? And what can they do internally? Because if they can continue, like a Chipotle can, and like we think Sprouts can, to do well in economic times that other companies are not doing very well, then the market is going to ultimately reward them for that in a big way by continuing to increase the price earnings ratio it wants to pay. In other words, it'll continue to overprice the business because of how consistent it is, because they can rely on it. And so in general, what happens to these great companies, these rare, really great franchises, is that the market comes to appreciate them so much that they're overpaying dramatically. And you just have to be aware that that is what is likely to happen. And
you're right. That is the trend.
Prepare yourself for that moment where you think, this is so extremely high. One day they're going to wake up and it's going to go down by 50%. And then you go through that cycle.
I have a question. Before the tech industry even existed, like back in the day, did that happen in the stock market? That companies really were massively overvalued and everyone acknowledged it?
Yes.
Okay, so it's always happened.
Yeah,
it's not just a tech phenomenon of like, who knows what, robots are about to be created.
No, absolutely not. I mean,
okay.
Look at it as company as old school and staid as a Coca-Cola, getting massively overpriced.
Oh, okay.
And then getting crushed down by 50%, right? I mean, it's definitely happened way before tech got rolling.
Okay.
Yeah, it's just market dynamics. Look at the real estate market, how it can go way, way up, way in excess of what the returns are from rent and all that. Just because other people are buying real estate and making money on it, people are going to jump in there if they see that money's being made.
And I guess I'm not. Go ahead.
If Coca-Cola's been going up, money's being made, other institutional investors are going to jump in there, driving the price higher. More money's being made. That brings in more institutional guys. Mm-hmm. And, pretty soon you're in the, the FOMO world, where, the fear of missing out. And that's bringing more capital in until it gets, finally something, one straw that no one ever knows what it really is, breaks the back of the whole thing and down it comes.
Exactly. Yeah, I'm not really asking about the bubbles so much. I mean, that goes back to the tulip mania in Holland with the tulips being
somewhat before the internet phase.
Somewhat.
What years were that? Well, that was like 1600s or something?
Something like that. Yeah.
Right.
But I guess more like in the sense of the market's sort of medium. There isn't some crazy overall change, but just certain companies being bid up. Because when we first started talking, you told me that usually companies would be, I'm going to forget the numbers, but relatively reasonably valued compared to a private company. So probably more like double compared to what a private company
roughly 2x. Sure.
Yeah.
That's the old days, by the way.
And that's the old days. That's exactly what I'm asking. Yeah, that's the old days.
Well, as you know, from being a mergers acquisition private equity lawyer, that has gotten extremely popular as the number of companies that are going public has shrunk by 50%. Mm. So private equity has become like the new, gold rush. And as a result, those prices for private companies have gone through the roof. So the old ratios no longer really apply.
Yeah. So I guess I'm wondering if these companies in a downturn, if these companies that are reliable and are winning in their industry and are probably buying other companies that are starting to fail, might be in this new age even more overvalued than they already are. And that's something as an owner, we could say, okay, it's still worth staying in because these guys have a ways to go.
Oh, I think that's true. And then there's always the fact that the market will recover and reprice them properly down the road,
Sure.
which is why we love this long time horizon, 10 years, 15 years, all the way out there. But yeah, absolutely, the market's going to appreciate these guys. And they have. I mean, I'll go way back to the early 2000s. Chipotle gets knocked down by just the market dropping, the whole market. And it gets taken down by about 50%. While its earnings, cash flow, revenue, everything didn't miss a beat. It continued to grow at over 20% a year in all of those categories, and yet the market just completely repriced it. But it didn't reprice it super cheap. It just took it down from super expensive to moderately expensive.
Oh, so one could say that's actually an appropriate repricing.
Yeah, exactly. And then, nice time to buy it. If you've already owned it, get some more. And that, of course, is ultimately the really sort of the final step on this. If we already own this business, we make an analysis, which we should be ready to make right away, of whether it's an OZK kind of problem, which changes the story, or it's a Chipotle problem, which is an opportunity to buy more. And then we often will look for an opportunity. We'll look at it as an opportunity to buy more and load the truck up, which is the right response
Understood.
for an antifragile company.
This is super helpful because I think applying the exact same principles during an event to a company you already own in order to find out if it's really an event makes a lot of sense. If it is an event, same thing. You would have bought in, maybe you buy more, maybe you just stick.
Go get more.
And if it's not a quote unquote event where it's going to get resolved in a relatively short period of time, then does that change the story enough?
Yeah, it changes the story.
Yeah.
Absolutely.
Okay.
So you'll go through all those in your investing career. You'll have opportunities for all of those decisions, on the basis of an event happening that is potentially changes the story. You're going to do one thing. It doesn't change the story. It's an opportunity. You do another thing. If you own it, you do a different thing than if you don't own it. Yeah. Pretty cool.
Pretty cool. Okay. Let's move on towards the holiday season.
Yeah, that's indeed.
All right.
So
thanks, everybody.
Thanks, you guys. Time to go play. Bye.
Thanks. Bye.
Hi guys, thanks for listening to InvestED. If you enjoyed this episode and you want more information or to listen to additional episodes, visit our website at investedpodcast.com and sign up for my virtual workshop right there. Spots are definitely limited for this event. I'm not kidding, they really are. They sell out very quickly. So everything discussed on this podcast, by the way, is either my opinion or it's Danielle's opinion. And really important, it's not to be taken as investing advice because I am not your financial advisor, nor have I considered your personal situation as your fiduciary. So remember that. You're on your own here. This podcast is for your entertainment and education only, and I really hope you enjoyed it.